Thanks for being here today. My name is Ellie DeWitt, class of 2019, and I'm a member of the Bold Council. The Bold Council represents all graduates of the last 10 years and works to enhance the connection between young alumni and Gettysburg College. We're very excited to be co-hosting the Alumni J-Term along with the Office of Alumni Relations. So now we're going to get started with the program. As you'll see, Joe has recorded the session, so that way people can view it later. So today's session, Dollars and Dreams, is co-hosted by Bret, who's class of 2000, and Mike, who's class of 2019. They both work at Creative Financial Solutions, which actually has 5 Gettysburg alums from 94 to 2019 that work there. So thank you so much for kind of hosting the session, and you can go ahead and get started.
Great. Thanks, Ellie. Give me a quick moment to share my screen, and we will get started. All right, so is that the beginning?
Yep.
That is the beginning. Oh, sorry. Thanks, Mike. There we go. Let's do it again. There we go. All right. As Ellie had said, my name is Bret Montich. I am a certified financial planner with Creative Financial Group. One of my partners, Mike McKnight, class of 2019, is going to help us out on this presentation as well. Quick disclaimer here, and I stopped sharing again.
Yeah, I think, Bret, you're actually on the last page there. That's
fantastic.
That's why.
Love it.
There you go.
I'm definitely not showing my age as a class of 2000 person at all.
That's what happens when we have a non-bold person leading the tech session.
It really does. All right, give me 1 second here. There we go. All right. And let's see if it shares. As I was saying, as my computer starts to share here, hopefully. Mike and I are going to go through our financial wellness. This is a seminar that we give to Fortune 500 companies as part of our job with Creative Financial Group. It is meant as a general overview of financial wellness for people. We'll dive a little bit deeper into a couple of the different subjects that are covered here. I will state that our presentation, when we give it to Fortune 500s, is designed to ask people to reach out to us for financial services at that point. So when you see the slides that says that you can have a one-on-one consultation, of course you can have a one-on-one consultation if you want, but that is not our intention to solicit you for business at this point. So please feel free to either reach out or kindly ignore those. So let's move forward. There we go. All right. Financial well-being. The Consumer Financial Protection Bureau, which was established after 2008 financial shock there, really defines financial well-being as 4 unique characteristics. And they are, as you can read on the screen, having control over your day-to-day, month-to-month finances, the ability to absorb financial shocks, being on track to meet your goals, and then having the financial freedom to do whatever you choose to do at that point. The way I like to think about this is having financial well-being really kind of equates down to having a plan for what you want to do with your money, and then not having to stress over the day-to-day minutia of your financial plan. Now, we're talking to graduates who literally graduated last year, to Joe Lynch, who graduated in '85. So we spanned a large list of different graduates here.
Hey, Bret, I think I'm the oldest. I'm 77. This is Pam Myman.
Oh, fantastic. Welcome, Pam.
I'm just really interested in this kind of stuff.
Great. So we spanned a large group here, and we all might be having a little bit different ideas of what means financial wellness for us. But this is officially what the government has defined as financial well-being. So this is our shameless plug that if you'd like to meet with us, feel free to reach out afterwards. And our agenda for today. We're going to talk in general about savings, investing, protecting, retiring, and estate planning. So the estate planning might be more on Pam's mind. rather than our class of 2020 friends. And savings might be more on the mind of some of our younger alums there. I'm going to talk through the first action item, and then we're going to have Mike take investing and protecting, and you'll hear from me at the end. So savings, couple of different things here when we think about savings. And really the biggest issue that we think, or the most important thing, is to make savings a regular part of your month-to-month investing cycle there. Back when I first started working at my first company 20 plus years ago, they used to say that you had to budget savings, or the more interesting way that they put it was you had to pay yourself first. And in fact, that's one of the middle bullet points there. Pay yourself first. A lot of people consider this to be one of your fixed income portions, or your fixed expenses portions of your monthly budget. And if you don't have a monthly budget, I would highly recommend that you at the very least track what's coming in and going out. On a personal note, I spend a lot of time volunteering with the local Boy Scout troop, and I am a merit badge counselor for their personal management merit badge, which talks all about money. And one of the fun things that we do, or at least I think it's fun, is we track every penny that comes in for a 3-month basis and every penny that goes out. And what's interesting is when I do this for my scouts, and I actually just recently did it for my daughter's Girl Scouts as well, the young scouts were amazed at how much money they were paying for various different things. We had one woman who was paying over $200 a month on DoorDash as a 7th grader. Now, some of us might do that, some of us might not, but I would put it in there that you should have savings built into your monthly budget plan. So a couple quick things here. When we look at savings, and actually I want to go forward. Sorry, I skipped one of the slides here. One of the things they recommend is 10% of your monthly budget should go towards savings. And your savings is really broken down into a couple different things. For our younger alums, you should focus on having an emergency savings fund. The rule of thumb is that if you are in a single income household, you should strive for 6 months worth of living expenses sitting in a short-term savings account. Ideally in some form of high yield savings vehicle, like a Capital One 360 or a Marcus by Goldman Sachs. Those are money market accounts that are paying, give or take, around 4%. The reason you want to build up that emergency savings is for when emergencies happen. So from a personal standpoint, about 2 weeks ago, I was going to bed and I realized our house was getting cold. And when I woke up in the morning, it was colder and our furnace was completely broke at that point. $10,000 later, we have heat in our house. And thankfully, I practice what I preach. We have a savings account that we were able to purchase that furnace without an issue and without putting it on a credit card. Now, whenever I give this presentation, there's people who look at me, or at least you would if you were in person, but you're probably thinking, Bret, 6 months of living expenses sitting in cash? Are you crazy? There's no way I can do that currently. And that might be an accurate statement. But what I would say is that you have to start somewhere. So potentially consider start savings, whatever you can, $25 a pay period, $50 a pay period. Have it come direct deposited out of your check, out of your paycheck, and go into a high yield savings account. Simply having your savings in a separate account that is different from your normal checking will make it mentally more difficult for you to raid that savings account on a month-to-month or day-to-day basis, and will truly allow it to sit in there for those emergency savings portions. The second thing that they recommend you save for is retirement savings. Most of us are probably doing this with either a 401k or a 403b. And typically the easiest thing to do is to sign up for those when you first get started and then put it in a target retirement date fund and let it grow. In fact, the US government recently passed the Secure Act 2.0, and they've mandated that all employers start having an automatic contribution going into your retirement account. And that typically starts at about 4% and increases by 1% each and every year until you hit 10%. Now, the law is a little bit complicated and wonky, like most things out of Washington, and it doesn't cover existing retirement plans, but any new retirement plans starting next year have to have that provision in. So the good news is if you start a job next year, in theory, your employer should automatically start putting away money into a retirement plan for you. The other advantage of those retirement plans is that typically there's a match on them. And what I really, really, really recommend people do is at least take advantage of the match. So a typical 401k match might be like 4%. In other words, if you put in 4% of your paycheck, your employer will put away 4%. Folks, that's 100% rate of return on your money, just having your employer match those contributions. Even if you just put it in cash, which is probably not where you should be, it's still 100% rate of return on your money. You absolutely should put that money into a retirement plan as well as saving for that emergency fund. And then the last big one on the bottom there are large purchases. Depending upon where you are in your life at this point, you might be trying to buy a house, you might be trying to buy an engagement ring, or you might be trying to buy a Porsche. All those things require a lot of money at that point, and typically we don't want to put those on the credit card. So having a budget, saving at least 10% of your monthly income towards those savings goals will go a long way. We talked about this one already, and this is an idea or an example of why you want to get started early. So this shows two identical 22-year-old kids right out of college, okay? We have the blue line that's going to invest $10,000 the day they get out of college and not a penny more at that point. And what happens is that continues to grow over the next 50-odd years. The green line individual decides that they're going to have a lot of fun in their 20s and 30s and not save any money until they hit age 40. And then at age 40, they're going to start saving $125 each and every month until they retire at age 70. The difference, as you can see, is the first individual invested $10,000, while the second individual invested 4.5 times as much, $45,000. And amazingly, they end up almost exactly at the same spot at age 70. So it truly goes to say that the early bird gets the worm here. And ideally, what you want to be doing is having a little bit of savings into a number of different investment vehicles. Your emergency savings, your long-term retirement savings, and then any other long-term large purchase options there. The final slide I'm going to talk about before I hand it over to Mike is this little slide here. And what this slide specifically shows is really the balancing of trying to pay off debt and save at the same time. So on the left side of our graph probably represents a large majority of our recent graduates. They have debt, either credit card debt or student debt, or maybe a mortgage at that point, and their monthly budget is consumed by a lot of debt payments, which makes their ability to save a little bit more difficult. Obviously, at some point in the future, you can cross over where your monthly dollar expenditures will then start to have more money going towards the savings than towards your debt. But the important takeaway from this slide is it normally should never be a all or nothing deal. We shouldn't put all of our money towards debt repayment, nor should we put all of our money towards savings. typically the best financial advice is to try to tackle multiple goals simultaneously. Now, the last thing I'll say about this slide here is if you do find yourself juggling multiple debt obligations, there's a number of different options to pay off your debts at that point. There's the snowball method where you find the smallest debt, you pay that off, and then you roll that payment into the next smallest debt, and so on and so forth. And then there is the financially smart way to pay off the debt. The best way to pay off debt is to make a list of all of your debts, what each individual interest rate is, and what the minimum payment is for each debt. And then you should tackle the highest interest rate debt first with the most amount of money that you have in your debt budget and make the minimum payment on every other debt obligation. Typically, this is going to be credit cards. Credit cards are single-handedly the most usurious debt obligations that we have out there. And routinely, we see credit card interest rates in the high 20s, if not 30% at this point. So again, if you find yourself struggling with debt, make a list of all of your debts, write down what each of their interest rates are, what each of their minimum payments are, and then tackle that highest interest rate debt first, because that's going to be the one that has the most negative consequences to you. So with that, I'm going to advance it and have Mike talk a little bit about investing.
Thanks, Brett. Okay, so I'm going to continue on here, and we're going to talk about investing and protection strategies for your monies. So investing is obviously, everybody has heard about investing, and, what does that really mean? And what does that mean for, people in different situations? Because, how someone who's just graduated college and is just looking to start either a retirement account or a regular investment account, which we call a non-qualified or non-retirement account, is going to be completely different than, someone who is approaching, their 50s, 60s, and in that gearing up for retirement age group, and then to, go one further, someone who is retired, how are we investing their money and making sure those monies last their entire retirement, because, that's been a really big, a really big topic in conversations these days with life expectancies, getting longer and longer as we go on. People are, outliving their money more often. So making sure, how we're investing the money is important, and, making sure it fits each individual client. So one of the first topics, or questions really we ask our clients or our prospects when we're having a conversation about investing is really, what is your risk tolerance? And risk tolerance can take into account a number of different things, and it also has to do with what kind of account we're investing in. Because if we're investing in a retirement account and we know that those monies can't be taken out before age 59 and a half without a penalty, as well as taxes, we're going to have a longer time horizon, and that's going to impact how aggressive we should be with those monies. Whereas if we're investing in just a non-qualified or non-retirement account with the goal of maybe buying a vacation home in 5 years, or maybe funding college for a kid who's going to be in school in the next 10 years, you're going to have a very different look on how those money should be invested and what they should be invested in. So, as far as your risk tolerance, you have people all the way on, as far as aggressive, down to conservative, and, that's going to be different for, each individual circumstance. Brett, you can go ahead. Investing is really, just a way to make your money work for you. And that's kind of how we look at it when we're talking with our clients, is how are we, putting our money to work so that it's not just sitting in, your checking or savings account, essentially, getting $0 at the end of each year, So there's a number of different vehicles that you can invest your monies in, and the different allocations that those dollars can be invested in as well. Now, when we talk about stocks, what we're really referring to is your equity portion of your overall portfolio. And buying stocks is essentially what you're doing is you're buying a share of ownership in a certain company. So, if you're looking at, you want to buy Amazon, what you're doing is you're buying a piece of ownership, a small percentage of ownership in the Amazon corporation. Stocks are generally going to be your more aggressive, a little bit riskier investments looking for the higher returns. A lot of people are going to have stocks in their retirement accounts, especially younger individuals. But we're also going to have a balance of your fixed income or your bond portions. So when we take a look at how we're investing, and going back at that last slide, if we're being aggressive or if we're being conservative, it's really putting together a blend of your stocks or equities as well as your fixed income and your bonds, which are going to be your more conservative pieces of your portfolio, and hopefully you're going to steady out your portfolio and give yourself some diversification in times of the market when the stock market's going down. So understanding your risk tolerance is obviously an important and critical first step of how we should be investing your money. And then also understanding what is the plan of the money. Is this money supposed to be used in the next 5 to 10 years, or are we just saving excess money and want to put it away for retirement, or potentially kids and your future kids and estate planning purposes. So understanding time horizon is critical as well. All right, Brett, you can go to the next slide. As far as your asset allocation, this is what I was just kind of tying that into. You can see in this example here, you have about 50% of your portfolio would be in your bonds. Now, these bonds can be, municipal bonds. They can be bonds issued by the government, treasury bills. You can have bonds that are in a number of different areas. And generally, like I talked about, these are going to be your more conservative pieces looking to earn, anywhere between 3 to 5% essentially on a year in and year out basis in your portfolio. And they're supposed to be really, diverse from your equities portion of your portfolio, meaning that, in years where the equities are taking a hit, hopefully the bonds are doing okay, where they can keep your, portfolio and your overall investment account in check. Now, if you have a year like 2022, like we just experienced, it's really, kind of an unprecedented year where we had equities being down about 19% overall with the S&P 500. But we also had bonds being down double digits, which, is really unheard of. Just kind of speaks to the kind of time period we're in right now, with everything going on with, money being paid back to the government. But bonds are making a return, and, a very critical piece of every person's portfolio. You can see they also have some cash equivalents in this example here. That's really your money markets or your high yield savings accounts, kind of like Brett was talking about, where money is liquid, but you're looking, really just for steady returns, some fixed rates. It might be your CDs, which are, really just another piece of the conservative allocation in your portfolio. And then lastly, you have your equities, which is your stocks that we talked about, looking for the higher returns. If you take a look at this example, this is a pretty conservative, overall investment allocation. I'd say this person is probably gearing up for retirement in the next couple of years, if not, even in retirement at this time, and really just looking to, preserve the capital that they've created over their years. You can go ahead, Brett. There are a lot of different investment vehicles out there that you can take advantage of as well. And two areas that hit on those different these different investment opportunities are real estate and your college funding, generally your 529 accounts. Real estate is a unique opportunity for a lot of clients who, most of my clients either, own their own residence, joint with a spouse or, on their own. But you can also look at, we have clients who have other real estate properties, looking to, diversify their overall investment allocation with some rental income, as well. So real estate is it's a great place to invest your money. Generally, we've seen pretty strong returns in the real estate market. And a lot of our clients like to invest in real estate, whether that be, in real estate investment accounts that are available, in the market, or if that is actually buying real estate themselves for either, their own pleasure, their own use, or for rental income streams. You also have here your college funding accounts, generally a 529 account, which a lot of our, clients, we discuss with them if they have kids or are planning to have kids, what are you looking to save for college? Because everyone in this, in this Zoom chat can recognize that college is expensive and you have to plan for it. And if you want your kids to not, have a ton of debt, you want to help them, save for retirement and plan for, the college savings plans. So the unique thing about a 529 plan is not really anything different on what it's invested in. You're still going to be invested in the same types of funds, that you can invest in any retirement account or any personal investment account. Generally, you're in mutual funds, which are a blend of stocks and bonds. But there's a unique advantage in college accounts in that the monies that grow in the 529 plans for you, if those dollars are then utilized for college expenses, they have tax advantages. They come out tax-free and can be used for tuition cost. Now, the one thing to be aware of with 529 accounts is if those monies are then not used for college tuition or for any type of education, there is a penalty for using those dollars or, taking that account out and putting it back in your checking or savings account that you would accrue. So we always just, tell our clients to be aware, and you don't really want to too much overfund your 529, but it's an absolutely great vehicle to begin saving for your kids' tuition, and have dollars set away for them so that when the time comes, they have a bucket of monies with a tax advantage that they can use. Protection. Protection planning is a huge piece of, Brad and myself's business in that, it as much as the goal to accumulate all of the different assets and all the different investment accounts and retirement accounts you have, it's just as important to protect the assets that you've grown and, your primary assets, in the event that, something should happen. And there's a number of different insurances that we look at with our clients. And you can see it here, it ranges from your property and casualty insurance, taking a look at your automobile, your home insurance, renter's insurance is another big one. And then, personal property, as well as liability and umbrella property for our business owners in particular, making sure that your properties are protected. And, if something happens or someone slips or there's any sort of incident, not all those dollars are coming out of your own pocket, because if, God forbid, the worst happens and something, goes on with your house, there's a fire, you want to make sure your home, being one of your biggest assets, is protected, and that, that's not just all money, lost on your end. So insurance planning is just as important as the accumulation of assets. Now, health insurance is an area that we discuss with our clients on these types of presentations. It's not necessarily an area that, myself at least, Brett, might be a little bit more versed in the health insurance industry. But I generally refer to, people more in that industry, to help my clients, make sure that they are protected from a health insurance standpoint. And it's extremely critical because, if someone doesn't have health insurance, there's really, everything else can be almost put on hold. You should not be putting money away into retirement accounts. You should not be, saving money on, different types of vehicles or college accounts or, investment accounts if you don't have health insurance, because, if something happens to your health and you need to have surgery done, or, you have to have an ambulance called, that can have a drastic medical or impact on your financial situation because of the medical costs, assumed in those incidents. Brett, I don't know if you have too much to talk about from a health insurance standpoint. I don't, particularly, I'm not as versed in health insurance as I am in some of the other areas of insurance.
Yeah, I think you hit the nail on the head there, Mike, in that you need to have it. Typically, all of us are going to get our health insurance either from our parents, if you're 26 or under, or from your employer, or through the government at that point. Health insurance, a lot of times there's not a lot of options that you have there. And I think the biggest thing that I would advocate for people is just know what your plan covers and what it doesn't cover. And specifically know if you have deductibles or co-insurances. Deductibles basically means you cover almost all the cost until you hit that deductible. Co-insurance means that the insurance company will pay for a portion of it, and then you pay for a portion of it. So, for example, if you're getting an ambulance ride and you have a co-insurance of 80%, typical ambulance ride can cost up to $5,000. An 80% co-insurance would pay 4,000 of that. You would have to pay 1,000. So it's important to know, what exactly your insurance covers there. I'll leave it to it for the life insurance, Mike.
Yep. So life insurance is a big topic of discussion for Brett and I with our clients, and making sure that, obviously your life is protected. And these conversations are going to be, most critical for our clients who are married, have kids, maybe have a house with a mortgage. But it is important to understand, the different types of insurances out there, as well as, what exactly they're doing for you, and what you're looking to accomplish. Myself, I'm not married or with kids right now, but I still own a life insurance policy because I know I have debts outstanding, and if God forbid the worst happen, I want to make sure those debts are paid, and that they're not, then being dropped on my parents, to make sure that, I'm protecting my own assets and debts. There are two main types of life insurance. And, for those who aren't familiar, there's term insurance and then there's permanent insurance. And even within these two different categories, there's different types of, in particular, permanent life insurance that you can look at. But term insurance is really, what's most utilized in the life insurance space. And that's because it's going to be your most economical type of life insurance. Term insurance is really to cover yourself for a specific period of time, generally when you have your largest amount of liabilities or debts, or if you have, young dependents, like young kids that are, you still have to pay for education, you still have to pay for schooling, sports, all the different things that you have to do, and your kids are relying on your income. You want to make sure that income is protected in the event that you're not around tomorrow. So term insurance is a very cost-effective way to protect yourself for a specific period of time. And when that time period's up, you can generally you'll drop your policy, because if you don't, your cost of insurance, it bumps up drastically. I mean, if you're just, for, give an example, if you're paying $1,000 a year for a term insurance policy for 20 years, in year 21, that insurance company will come back to you and say that if you want to continue the policy, instead of paying $1,000 a year, you're going to pay something like $8,000 a year, and that's going to be increasing every year. So generally, you want to make sure you have the correct period of time in when you're looking to place those term policies. Permanent insurance is exactly as it sounds. It's permanent. You're going to have it for the rest of your lifetime. It's not going to go away as long as you continue to pay the premiums. And there also is the opportunity for growth with cash value that's accumulated inside of these accounts. Generally, the two most, talked about types of permanent insurance are your whole life insurance and your variable universal life insurance. Both of those accumulate cash value that has tax advantages, and you can use those dollars for really whatever you'd like to use them for. We have clients who will use them for their kids' education. You can use it to supplement your retirement income. You could use it for going on a vacation. Really, that's up to you. But those are the two different types of life insurance. As far as your disability insurance, a lot of individuals have disability insurance through their employer, but it's something that you absolutely want to make sure you reach out and take a look at it and make sure what is your policy if you do have one. If you don't have disability insurance through your employer, it makes a lot of sense to reach out to an individual who works in this industry and understand what are your disability insurance options available to you, and making sure that you're protecting your income, because if something happens to you and you're out of work for the next 3, 6, 9 months to up to 2 years, that's going to have a drastic impact on, your financial stability, your financial life. If you have kids, if you're married, and your spouse and your kids depend on your income, and all of a sudden that's taken away from you, what happens? And even if you don't have kids and maybe you're renting, an apartment on your own or with a friend, and all of a sudden, you're out of work for the next, 6 months. How are you going to pay rent? So making sure that you have disability insurance is extremely critical, and it's really an overlooked piece of financial planning. But it's definitely something that's extremely critical, and gets utilized a lot more than people think. I'll just say that. Retiring. Is this still me, Brett, or are you?
This is me. Thanks, Mike.
Yep.
All right. So we have 2 more sessions, retiring and estate planning. So a friend of mine actually called me this morning and told me that he was retiring, which is amazing. The biggest key to retiring is developing a budget. So this slide shows you what a typical retiree might be spending in their budget on a year-by-year basis. Interestingly enough, this is also similar to what a new college graduate might be spending on their budget moving out. It doesn't really change a whole lot. The big one that does change is that yellow dot, which is healthcare. Hopefully, if you're still working, the majority of your healthcare costs are covered by your employer. But again, the takeaway here is regardless of where you are in your life cycle, you want to make sure you have a good understanding of the money coming in and then the money going out at that point as well. So when we think about retiring, there's a couple of different income sources that you can count on in retirement. And specifically, you can read them here. Social Security, retirement accounts, pensions, annuities, personal savings. We break up all of our investments, or at least our retirement planning, into what we call the 4-box method, which I'll show in a second. But it is important to take a note here, or take a moment here and note that a couple of these income items are becoming sort of critically endangered. So pensions, unless you're a teacher, a cop, or a politician, it is rare to see pensions at this point. And even teachers, I can speak for the Commonwealth of Pennsylvania. My wife, who started teaching about 15 years ago, has one form of pension, and brand new teachers starting this year have a completely different, less advantageous type of pension. It is very common for corporations to be cutting their pensions. And about the only ones that aren't cutting their pensions are our service people. So that would be our military, that would be our police and firefighters. And then, of course, our politicians never vote to cut their own pensions at that point. The other one that is sort of a hot button issue right now is Social Security. So Social Security puts out an annual report telling us when they're going to run out of money, and that number keeps getting closer and closer. It's roughly a decade away, and if our politicians do nothing, what will happen is the Social Security will pay approximately 85% of the promised benefits there. So if I'm Mike's age, class of 2019, I'm feeling not great about the Social Security scheme at that point. And by the way, that is the name that the government uses for it. It is a scheme. I always thought that was interesting. If I'm Joe Lynch, I'm feeling pretty good about Social Security because I'm close to it. Myself, at the tender age of 45, I'm kind of ambivalent towards it. So a lot of times when Mike and I are doing financial planning for our customers, depending upon your age, we may or may not factor in Social Security. Ideally, if we can retire without Social Security, then that makes our retirement more secure, and anything that comes in would be gravy at that point. So, and this lost one, I love when it skips ahead. There we go. There's my 4-box method. So our 4-box method in general wants to figure out our lifestyle costs and our income sources. And to make this as simple as possible, on the right side of this 4 boxes is our lifestyle costs. And we break that down between retirement wants and retirement needs. So if you think about your budget, there are things that we want and things that we need. We need shelter, right? We got to have a place to live. We need clothes. It is socially irresponsible to walk around without clothes at that point. We need health insurance. We need to pay our taxes. Those are all things that we have to do in society at that point. I would like to go across the pond and catch a couple Premier League soccer games this year. That's a total discretionary expense, and that's a 1 at that point. In retirement, I'd love to see every major league ballpark. Again, that's a 1. I don't have to do that. So when we're working with our clients getting ready for retirement, we want to break down their budget between retirement wants and needs. And specifically, I will make sure that their needs are covered by dependable income sources. So dependable income sources are pensions, Social Security, depending upon your age. And then if we don't have enough of those traditional dependable income sources, then we can purchase products that will create a dependable income source. And typically those are annuities with guaranteed benefits at that point. Everything else we can have invested in the market because it is a discretionary want at that point. So the example I'll use is if I was retired last year and I wanted to hit all 30 major league ballpark stadiums, but I was looking at my investments and they were down, let's say 20%, like the S&P 500 was, I could easily defer that trip for a year if I chose to do so and wait for my investments to come back. So again, in figuring out your retirement system, we want to make sure that your retirement needs are covered by dependable income sources and that everything else, your wants, can be subject to the vagaries of the markets and those sort of things. Now, in some of our other presentations, we dive into tax structures of retirement. And while I don't have a slide on it today, I'm going to talk very briefly about it. We talk about the golden tax triangle. And Mike alluded to this earlier. There are qualified accounts, which are tax favored, and non-qualified accounts, which have no tax benefits. Inside of your 401k, you probably have the option between a traditional 401k and a Roth 401k. You also have the options of traditional versus Roth IRAs. And put simply, a traditional IRA or 401k is going to give you a tax deduction today, but is going to become 100% taxable when you take it out at retirement. A Roth 401k or a Roth IRA provides no tax deduction today. However, when you take it out 30, 40, 50 years in the future, after it's spent all that time tax deferring, that money comes out 100% income tax free. And I just did a 401k enrollment for a company that we managed their 401k yesterday out in Ephrata. And I shared with them my rule of thumb for which one is best. And quite simply, if you are under the age of 40 and make under $100,000, I will almost always recommend that you pick the Roth option because you have a lot of time to let that money grow. And when it comes out, you're going to get a bigger benefit. Plus, you're in a more modest tax bracket currently. If you're over 40 and make over 100,000, in many cases, the traditional is going to be the better option for you. Now, if you only check one of those boxes, you should have a discussion with a financial planner and they can run those costs for you. So let's move forward. Our last item that we're going to talk about today is estate planning. And some of you are probably sitting there going, Bret, I look a lot like Mike. I'm single. I don't have kids. I've got some debt. I've got some investment accounts, but estate planning, you got to be kidding me, right? I will tell you, everybody needs an estate plan because if you don't have an estate plan, the government will choose where your money goes at that point. And at least here in the beautiful Commonwealth of Pennsylvania, our government has some pretty wacky ideas about where your money should go. So full disclosure, I am happily married to an amazing spouse for the last 18 years, and we have 3 beautiful children. If I don't put beneficiaries down on my accounts, the Commonwealth of Pennsylvania has decided that my beautiful wife gets half of my accounts and that each of my 3 kids get 1/3 of 1/2 of the rest of the accounts. And because all my kids are under the age of 18, whenever my wife needs money out of those kids' accounts, she has to contact an attorney that represents each of my 3 separate kids. So she has 3 separate attorneys to go to. All of that can be avoided by simply listing beneficiaries on your accounts and having a simple will. I would argue that everyone on this call should spend 15, 20 minutes Googling basic wills. And if nothing else, get your college buddy to get together and write a will at that point and take care of it. It really ensures that smooth transition of assets. And there's a couple of interesting stories of note here, and I'll make it quick so we can open up for questions. My 2 favorite dead celebrities are Michael Jackson and Prince, and they are on complete different opposite ends of the spectrum. Michael Jackson, believe it or not, had his stuff together and put his money in trusts and all sorts of wonderful, wonderful vehicles so that we have no idea how much money Prince Michael and Blanket have at this point, and they have almost complete anonymity with their money. Michael did a great job with his estate planning. Prince was a disaster and had no wills, no anything done. And he is now, or more accurately, his estate is being sued by all of his relatives, including, at last count, 7 people who claim to be the illegitimate child of Prince and are going through DNA testing currently. It is an absolute nightmare. So please, be like Michael, not like Prince, and spend a few minutes and get an estate plan together. It basically involves getting your wills put together. It might involve gifting if you're in a high net worth individual. Shameless plug for Gettysburg College here. They would love to have your gifts if you're a high net worth individual here. Life insurance can be a great tax vehicle for estate planning, and then sometimes trusts as well. So with that, our review today, we talked basically about these 5 options: saving, investing, protecting, retirement, and estate planning. I'd like to offer the last 8 minutes to see if anybody has any questions. And I will state that general questions are the best. It is probably not the best time to answer if you should short Tesla to pay off your student loan to then buy Bitcoin. Those sort of specific questions there. So if anybody has questions, please let us know. And then again, Mike and I are available if you have individual questions. We could answer those offline by simply shooting us an email.
I'll ask a question.
Go ahead.
Would you recommend, as like an early saver, early in my career, having my savings account be an investment account, like a Vanguard account, or there should be a separate like saving for emergencies in that high yield growth account, like you said, and then separately be investing, not at the same time conflating the two?
I'm okay if you are able to separate and differentiate them inside of your Vanguard account. I happen to be a very simple-minded person, so my savings account is at Capital One 360, and my investment accounts are where they are at that point. It's just a very clear delineation for me, so I'm not tempted to then, buy that Tesla to short Bitcoin and do whatever with my savings account.
Thanks.
I'll just say, Brett, as the older person in this group, I love your slide about 10,000 invested at age 22 equals $45,000 invested at age 40. So that's, I think, a great graphic, a great concept to keep in mind.
That is good.
Yeah, if I could give you all any advice, it is absolutely start that Roth 401k at your employer because it pays dividends. And I love showing, I had a little slide with my daughter, Girl Scouts, and she put $600 into a Roth IRA. And I showed the young ladies, if they did that each and every year, starting at 15 till they reach 60, how much it would be. And they're like, $600 for, I don't know, 50 years, what it's going to be, $100,000. It's like $1.3 million. So again, that time in the market is your biggest asset as a young person.
I just want to say thank you to both. This is Pam Myman, to both Brett and Mike. I think it was really good. And I think also what you're saying there, if you start doing that from the very beginning and it's automatic, you don't even miss it because you never had it and you always planned that way.
Right.
Yeah.
And
thank you, Pam.
Yeah.
And I would say a lot of our clients, one of the best ways to practice, budgeting and saving is to have those 4 savings vehicles, things where it comes out automatically, and then really you just learn to adapt and live with, what's left in your checking or savings account. If you if you want to set up an investment account and have $100, $200 a month come out, automatically, you'll start adjusting elsewhere, in your financial life, and then it becomes easy. And then next thing you know, you're looking to increase it. It's a lot easier than every month going in and saying, I need to go deposit $200 in my investment account because I haven't done it yet. That can be hard, and you'll find excuses on why not to do it and why that money should be used on going to a Sixers game or, whatever that may be. So for savings is for a lot of our clients the best way to, start those good habits and really build up the savings.
And I know I'm the oldest one here too, but one thing I think, and you probably do this for your clients getting, older than the majority of the people here, is looking at long-term care insurance too. But that's for people later on. My husband and I happened to get it early because it was offered as a group plan at our company years ago. We don't work there anymore. So you got that group plan price and it was portable at the same, and it was cheaper. But I don't know if you guys go over that with later people.
Yeah, we do cover long-term care. That wasn't on the slide, but it's a great point that you bring up. Long-term care is is a huge, part of a financial plan and could be one of the biggest, deteriorators of a financial plan if someone were to need any sort of long-term care assistance. So that's great that you found a plan, especially one that's portable, and you were able to hold on to that plan even after leaving your company.
Perfect.
It wasn't
Well,
on my radar when I was younger, though. It wasn't until like, I guess it was offered like when we were 35 or 40, but no, it was cheap, so we got it.
so I'll take the moment to just say thank you all for spending your lunch hour with us, or at least on the East Coast, your lunch hour. Maybe it's your early morning coffee hour if you're on the West Coast. If you have any questions, please feel free to reach out. We're happy to help. And hopefully this was worth your hour.
It was great. Thank you.
Thank you.